58. Why is it? Oh, we're live.
Hey, we're live. Wait, we're live.
2 minutes early. We're actually early for once, Joseph. That's,
we're so good at this. We're good at this.
I know. We're getting much better. Hi, good morning. Brenden Rendo with the Homes in Orlando team at NextHome Neighborhood Realty, and of course my good friend Joe from Appli Home Mortgage. How you doing?
Doing awesome.
And of course we are. The Orlando Real Estate Buzz. We are a weekly video podcast, I guess is what they call them now, that comes to you. And our whole goal is to keep you up to date on what's going on in the real estate market. This year's been a ball because it's changing every single day. Absolutely.
Yeah, absolutely. And this could have been really boring if we did this like 4 years ago.
Oh, it would have been. Yeah. It's like, rates are the same. They're really low. They're great. Yeah.
Market's stable. It's appreciating at the same rate.
Yeah.
We would have been the clear-eyed guy. What is that? Ben Stein or whatnot?
Exactly. Well, I picked, since it was my week to pick, I figured I would pick one of Joseph's favorite topics in the whole world: adjustable rate mortgages.
Oh my gosh, I love this topic. What are you talking about? Like, yes, of course.
The main reason why I did that is looking at the numbers and with the interest rates going up. Mm-hmm. One of the first things you see is people starting to all of a sudden warm back up to the adjustable rate mortgages. And you've seen it in several of the headlines. I can pull it up here. My mouse is jumping all over the place today. Mm-hmm. So, there it is. Share. Oh, wait, hold on. My bad.
Nope, never mind.
Yeah, This is the headline from Iman News. I believe it was yesterday. May even been this morning. I was catching up on emails. And what it's showing is that basically, with interest rates jumping 1.5 points, people are now starting to look at ARMs, which is basically an adjustable rate mortgage. And we've jumped in the past 3 months from about 9% of all loans being adjustable rates to 17%. So the number of adjustable rates has just about doubled. And I know people always have questions. I actually got a call last week from one of my clients because they had qualified for about $350,000, and they're like, "Is there any way, with the rates where they are, I can't afford that. Is there anything I can do that might still help me get into a house?" Mm-hmm. And really, the only thing I can think of is, we might be able to look at either what's called a 5-1 or 7-1 adjustable rate mortgage. Mm-hmm. So, when we look at the rates today, you can see why. This is right off Mortgage News Daily this morning, and you'll see the 30-year sitting about 5.3.
Yeah.
Then nationally, your 5-1 ARM is sitting about 4.2. Mm-hmm. So you've got about a point difference. That's a big difference for people.
Yeah, it's definitely interesting to see that change. And the cool part is like if we were having this conversation 10 years ago or something, like a lot of ARMs, like the adjustable rates, you would actually have to qualify off the ceiling, like the highest possible rate that it could go. But now you qualify off that initial term. So it does give you more buying power.
Can you explain what a 5-1 ARM is?
Yeah, so that first number, so typically on an adjustable rate, they have fixed terms, so they're like 30-year or 15-year or whatnot. But that 5-1, that number that you see, so 5/1, the first number is how long that initial introductory rate is locked in. So 5 would be 5 years, and then 1 is every 1 year after that 5 years, your rate can change. Now it can go up or it can go down, and there's a ceiling and a floor. So it'll never go down way a whole bunch, or it'll never go up a whole bunch.
Okay.
Usually it's about usually 2.5% is the ceiling above and the floor.
Mm-hmm. So when you're looking at this might be good for people who know typically every 3 to 5 years, I like to move. I have a client like that. They're wonderful. Great people. They've actually been in their house for 2.5 years. And I can't believe it.
Yep.
We literally about every year we would go. They would move. They'd find another house. So for them, it could be a great move. But,
it could be. And usually you see like kind of right where we are now, when rates are very kind of all over, very volatile. This is when you see ARMs start to get more attractive. When rates were really, really low, like a year ago, an ARM may have been the exact same rate as a 30-year fix. So it didn't really make sense. Now there's volume buckets. There's a lot of investors and lenders that are getting really, really aggressive on ARM pricing because they're giving that low introductory because they expect rates to rise. And it's kind of like they think, hey, like short term, we're going to get that volume short term, but long term, rates are going to rise. Borrowers are going to stay in this because they can't refinance out, and they're going to be there. For me, like what I typically like to coach clients, I like to target the 7-1 or the 7-6 ARM. And a 7-6 ARM, the 6 is not 6 years, it's actually 6 months. But I like that 7 because locking in for the first 7 years, that fixed rate.
Yeah.
The average homeowner, right? The average person historically is in their home or their mortgage for 6 years. So the 7 is kind of like, hey, we're hitting just above that average historically.
Which makes a lot of sense too, because chart wise, going back and looking at rates, everything kind of runs on a 7-year curve. You hit your peak, then it takes about 7 years to come back down, then it goes back up, then it comes back down. And if you go back through, look historically, we're pretty close to that. I know I was reading the New York Fed released some survey numbers on homeownership.
Yeah.
And it's actually 8 to 10 years now is about what most people feel that they're going to live in their house. Is somewhere in that ballpark. So again, the 7 seems to make some good sense. 5 get you hair better in the pricing, but nothing major.
Yeah.
So.
And the key here is and the reason why you joked, you're like, it's Joe's favorite topic. I think ARMs are a great product, but I think it takes having a great loan originator, a great mortgage advisor, someone that's in my shoes, guiding people and really explaining it. I've talked to a lot of clients that, they're being told one thing, and the person that they're talking to from another lender, and they're getting a second opinion with me. And I'm like, homeboy over there didn't know anything about this product, but sold you on a low rate. And he's about to set you up for a whirlwind of trouble. Let's pause. Let's talk about it. Let's make sure you understand it, because it is a little bit different. And there's a lot of people that are just saying, here's a rate, and they're glossing right past this and not having those conversations with clients.
Well, what that goes back to is back when we had all the 228s. Remember those?
Yeah.
During the early 2000s, which got our whole housing system crash.
Kind of created the mess.
Yes, that created the mess. I mean, you were locked in for 2 years to start with. It was a super low rate. But boy, once that 2 years hit, which was 2006, 7, 8, all of a sudden your payment went up. Some people thousands of dollars.
Yeah.
And people are like, I didn't know it was going to adjust. It's like, what do you mean you didn't know it was going to adjust? Didn't your loan officer tell you that it's a 228 ARM, it's fixed for 2 years, and then it's going to adjust every year after that? And those ones, like the cap on them was like 4 or 5%.
Ooh.
I mean, I mean, when you actually read the details of them, and it's like, okay, I could go from 6% to 11% overnight.
Mhm.
No
Yeah.
wonder no wonder it caused so many problems.
And here's the thing, like I talk to so many clients and so many people that, their insurance goes up, their taxes go up. Maybe they had an escrow shortage at some point and they're calling us for like advice on, hey, should I refi? What should I do? My payment went up $150. I can't afford this higher payment. Like that, like you could see a much bigger increase when you're in an ARM.
When you're in our,
like that's just the fact of the matter. You're borrowing $400,000, $500,000. You get to that first adjustment period, you may see a $400, $500, $600 change in payment. You could easily. Yep. You might not see any. Maybe you get lucky and it's actually lower. But I typically say this: if lenders are trying to get people into these programs right now, like I think I'm a smart guy, but the people that are determining what rates are being offered are a lot smarter than me. Like those guys, if they're going aggressive on this, they see something bigger scale than I see, because
there's something out there that they see that we're not seeing, because that gap right now, just over a percentage point, that's a pretty big gap.
Yeah.
From a fixed rate, from the 30-year fixed to the 5/1 ARM.
Yep.
I remember them, being a little bit smaller, more like a half a point, maybe tops 3/4. I don't think I ever remember it being over a point.
Yeah.
in difference.
Yeah, but I'll definitely say we're doing a lot more ARMs today than we were. I mean, historic. I would say even venture that in the last 90 days, we've probably done more ARMs than I did in the last 2.5 years combined.
Mm-hmm.
Like,
that makes sense from the numbers that we're seeing from the Mortgage News Daily, from Iman, where they're saying that basically it has doubled for people.
Mm-hmm.
So, so if you've got questions, that's one word. Reach out to us, but make sure you've got the details.
Yep.
You got to know the details, because the worst thing in the world is you get that surprise, going into your 6th year, and boom, your rate has jumped 2 points and your payment's gone up, $600, $700, $800. That's an awful feeling.
Yeah, and we don't have the crystal ball on our end. We can't say exactly what's going to happen. That's why I typically, when I guide and advise people, we talk about it. And usually you're not going to hit that ceiling. There's a cap on how much it can go the first time, and then a lifetime cap. They're different. But the reality is it's still big adjustment. And I really talk to people that if you think that you're going to be in this long term, like we've got an increased rate environment. We have this, like that. I would still lean toward, hey, let's get you into a fixed loan, not the ARM. Or if you're someone now, like if you're a younger professional or you're growing in your career or something of that sort, you expect your income to continue to climb, ARMs can still be very attractive. But I'm not putting someone on a fixed income that's sitting there on the tail half of their career, getting ready to look at, hey, I'm retiring in 5 years, and say, all right, no. and putting them into something like this, because that's just setting them up for failure.
Yep. Agree with you wholeheartedly. So, well, that's what I wanted to cover today. It's just, answer a few questions for people, get into a little more detail, make them aware, hey, they are out there. It's something to look at.
Yeah.
But be careful of the details. Look at what is the worst case scenario. Hey, if in 5 years rates, my gosh, you look at the rate charts these days. I was looking at this one this morning, because they were going through purchase applications, and the housing sales stayed pretty steady, but the purchase applications have continued to decrease.
Yep.
And you can see it here.
Yeah.
But look at this. This is your mortgage rate graph. Boom.
They're about to extend that. They're about to move it up even higher.
Yeah. If this was a roller coaster, man, we'd be having fun. We'd be like, get to the top, get to the top, get to the top.
And you know, you joke and I laugh, like just last week we had this same thing and we were talking about, hey, rates steady the last 2 days. Maybe we see a trend. We need to see 3, 4, 5 days before we can start saying a trend of improvement. And what happened? The Friday happened and it was like, boom, way worse. And then we get back to this week and I was like, okay. And then it started to improve again. And then it kind of got worse. Like
I'm scared for Fridays now. I mean, it's just, you know, what, 3 of the last 5, 4 of the last 5? We've just been hit hard with different news.
And I feel like a lot of these investors are anticipating that you know, that news dump Friday. Like, hey, like, you know, they're anticipating bad news. A lot of them, I feel like, are hedging for the week. That's all they're thinking about. All right, what's it going to do this week? And then when Friday comes, a lot of these, you know, the rate charts, and I feel like the pricing, what's kind of happening is kind of like, hey, we're going to get worse because we're not sure what's going to happen this weekend, and then we'll reassess on Monday. Like, you know, and that's kind of what I feel is happening because there is so much uncertainty right now. I mean, the Ukraine and Russia is still going on. Like, you know, we haven't seen that. I've been noticing that, you know, not as big of news, but things that are going to have an impact. There's a lot of production plants for, like, you know, foods and this and that have kind of gone up in flames and have burnt down or had damage. And I'm like, this is kind of weird. And those are going to be things that, like, you know, we're going to see supply chain issues continue to stack up. And what's that going to look like? So I think what we're seeing with rates is kind of like, and what I tell a lot of my clients right now is like, hey, like, when it gets to Thursday, I'm like, tomorrow's probably going to be worse. Like, we want to lock in. Like, you know, if we don't lock in, if we get to Friday, it's kind of like, might as well wait till Monday, Tuesday, see if we get some improvement because we see some pretty big swings. But we're not going to see huge swing. You know, we're not going to see it jump back down to like 4.875. You know, we might go from 5 1/4 to 5 1/8 or 5 1/2 to 5.375, you know, on the downside. But on the flip side, we could be at 5 1/4 and be at 5 1/2 by the end of the day.
Yeah.
If we have a bad day.
Yeah. Yeah. It's just like, okay, Friday's coming. Everybody keep your mouth shut, please. Don't say anything that's upsetting.
I'm just going to start taking Fridays off. I'll do it on Monday.
Don't blame you. Don't blame you there. So anyways, those are, we hope you enjoyed that. If you have any questions about adjustable rate mortgages, you know, please feel free to reach out to Joe, reach out to me. We're here to help answer those questions and other questions in the market. Have a wonderful day, Joe. I know you got a busy one, so take care. And we'll see you next week. All right?
Rocket.
Bye-bye.